President Trump's tariffs are moving ahead, pressuring risk assets, while the ASX 200 futures test key support amid weak iron ore prices. What we do know is that tariffs are set to come into force this week. Here's President Trump speaking at the White House.
No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow.
Mr. President, just to follow up on my colleague's question.
And just so you understand, vast amounts of fentanyl have poured into our country from Mexico. And as you know, also from China, where it goes to Mexico and goes to Canada. And China also had an additional 10, so it's 10 plus 10. And it comes in from Canada and it comes in from Mexico. And that's a very important thing to say. Yeah, please, go ahead.
Let's get more now from David Scutt from StoneX. Great to see you. Obviously, we are talking about tariffs and the developments for global markets because we knew that there was a bit of a reprieve for Mexico and for Canada after that phone call, but now they're back and they're at 25% and the markets are not happy.
G'day, Aaron. Great to be back. And you're right. It was already under pressure, a lot of the riskier asset classes last night, US equities. And then that line from Trump came out confirming that those tariffs were going to place, 25% on Canadian goods ex-energy, 25% on Mexico, and an additional 10% on China. But mysteriously, despite the implications, and they're very negative implications for the global economy, for now, a lot of the major stock indices and stock index futures are still actually adhering to technical levels rather than anything fundamental.
How significant are the tariff developments for global markets? Which sectors do you think will be hit the hardest?
Oh, look, it's almost all sectors because at some point it's going to have to go and realign trade flows and the like, supply chains, and just the uncertainty that it creates as well. From an international perspective, you go and look at what's going on with the European Union. That's an area that I'll be very concerned about at the moment. And then Trump as well this morning brought into the equation currency, and potential currency manipulation as being something that might warrant tariffs. So then you look at the likes of Japan, who have got a very, very weak currency right now. So it's going to be a very trying period for the global economy and for financial markets.
Well, the Americans have been frustrated with China and pinning the yuan on the US dollar for such a long time as well. Let's talk about the ASX, so the 200 futures testing a critical support level. What do you see as the key indicators that we should be watching?
Yeah, Aaron, we'll bring the chart up on the screen. Right now, it's you can see the red line. That's the 200-day simple moving average. Just basically telling you where the average has been over the past 200 days. And you can see there that it's a level that's often tested, but very, very respected. You can see back in August of last year, we saw that it was tested on multiple occasions and held firm on every single one. Again, it was tested at the start of this year, and we're seeing it tested again. So it's a really, really important day from a technical perspective. If we were to go and break that 200-day moving average, then you'd go and open up the door for a potential much larger decline coming through. And coincidentally as well, right now, we're also seeing the NASDAQ 100 index futures in the States and the S&P 500 testing those key moving averages as well.
All right, let's talk about iron ore. The prices have slumped, and that is not good news for Australia. What impact do you think it will have on the mining sector in Australia and also the broader market heading into an election?
Well, it's the biggest constituent when it comes to market weighting on the ASX 200. So we've got to go and consider what's happening here. It's managed to go and pop ever so slightly back into positive territory late in overnight futures trade. But still, we're sitting about $100 a tonne. That's come down quite dramatically, about $7 or $8 a tonne in the past few weeks. So keep a really close eye on this because that's a big revenue earner, not only for those companies, but also when it comes to excises and the like for state governments and the federal government. So if we see weakness coming through in the iron ore price, every Australian is going to go and feel it in some form or another.
Yeah, very much. Now, obviously, US economic data weakening, European indicators remaining strong at the moment, Trump's policy shifts adding a lot of uncertainty for investors. How do you see that uncertainty affecting market confidence?
Well, you can't really go and tell exactly what's going to go and happen from not only one day to the next, but 1 hour to the next. We led the story talking about the Trump tariffs coming into effect on March the 4th. I still can't sit here with any certainty and say that there won't be a last-minute reprieve. And I think that a lot of investors are looking at that, a lot of business owners are looking at that, and a lot of consumers are looking at that. And it's just such an uncertain environment. And we really saw that firsthand in the ISM manufacturing PMI that came out from the States overnight. Now, it didn't suggest that there's the activity's falling in a heap, but you can see here. So some of the key information that's coming through the pipeline. New orders tanked in negative territory, so that means that they're declining. You look at employment, declining as well. So net, most are saying that they're shedding workers at this point in time. And then look at the prices paid. Now, this is an area where you can be influenced by sentiment. It's survey, it's not hard data. But that was the biggest increase in prices registered in a year. Now, you put all those things together, that equals stagflation.
Yeah, well, let's talk about Germany now as well. We've got this chart, the Fed now expecting, rate cuts, but what do we know about Germany? Because the Treasury curve suggests weak future growth. How does this contrast with Europe's outlook?
All right, so this is a bit of education 101, but it's really, really important because it explains a lot of what's going on at the moment, particularly in currency markets. So on the left-hand side, you've got the US 2s10s curve. So what that is 10-year Treasury yields less 2-year Treasury yields. On the right-hand side, it's the same deal, but for Germany. And you can see the shape. So what we've seen at the moment in the United States is that we're seeing a flattening of the curve. That's basically a tempering of growth expectations coming through. But on the German side of the equation, you can see that it's starting to go and steepen up, and it's positive. So what the market is saying there and what the bond market is saying in Germany, the Bunds, is that they expect that growth is going to strengthen in the future. So that's really important when you look what's going on at the moment with the US dollar and the euro. The euro was up over 1% last night, and that was on the back of some positive remarks and hopes for increased spending coming through in military places to go and obviously try and help with the deal to go and solve the Ukraine conflict.
Let's talk about the Fed, now expecting 3 rate cuts in 2025, also weakening the US dollar, adding pressure to stocks as well. Then there's OPEC Plus moving to boost oil supply. How does it all come together to influence market sentiment?
Well, the OPEC Plus news was very unexpected. No, they're going to start adding barrels back onto the market, as previously slated, but also as previously delayed on multiple occasions. So from April, an increase of 138,000 barrels per day coming back onto the market. That's gone and seen crude prices come off. All things being equal, that should go and lessen inflationary concerns. But when it comes to the Federal Reserve, what we're seeing now is that markets are not really focusing so much on the inflation side of the equation. They're focusing more on the growth side. So the fact that we're seeing this build-up coming through when it comes to Fed pricing, and at the moment we're priced for 3 rate cuts from the Fed right now. Less than a month ago, that was 1. And that's where the problem is for the markets, because it's not about inflationary pressures coming down, which is now driving that increase in Fed rate cut bets. It's now growth concerns. And that's when you start to filtering through to earnings and the like. And that's why we're seeing, as long with the tariffs that's going on at the moment, that real pressure coming through on those riskier asset classes.
You spoke about OPEC Plus before, adding barrels to global supply. How soon do you think consumers will see lower fuel prices? Because that leads into inflation data as well.
There's not a direct correlation when it comes through to refining prices and then what you actually end up paying at the pump, but it should be seen probably within the next month to 6 weeks. As you run through inventory, as you get those runs coming through from some of the refineries in Southeast Asia, that will then eventually go and arrive here in Australia and should be felt. So all things being equal right now, I think most capital cities, you're seeing an adhere in the price cycle just for normal unleaded petrol of around about 160, 165. We might see that start to go and push down towards 150, but a lot of water to go under the bridge on that front, and things can move around pretty quickly. But for the time being, we're seeing crude prices go and fall to 2025 year lows in overnight trade.
Well, we like the sound of that, and we love water under a bridge. David Scutt, appreciate your time. Thank you.
Great to be here, mate. Take care.